Brett did a fantastic job earlier talking about the Alberta landscape as a whole. And then we're going to go into the tool itself, the MLI Select tool. I would really love to educate everyone about today. And then we'll go into the multifamily advantage, why it is outperforming in this market. And then we're going to talk about the skill, building wealth and protecting your assets, basically. Take a look at Alberta specifically. Over 200 new residents moved in between 2023 and 2024. You saw that graph when Brett pulled it up earlier. Over 200K residents moved into Alberta specifically. And there's a strong interprovincial migration, basically people moving all the way to Calgary, especially Alberta generally, but Calgary especially. A lot of interprovincial migration from Ontario, from Saskatchewan, from Manitoba. Everybody is coming to Alberta. So it's been, even beyond 2024, it's been on an incline. And it's mostly employment driven. So we see how a lot of people are moving around here, mostly because of employment. And Calgary, Calgary, of course, is one of the fastest growing cities in the whole of Canada. All right. And as you know, population growth equals housing demand. So this is our current reality in Alberta. So smart investors look to take advantage of this demand. Now let's get a snapshot into the Alberta rental market. So we see that in 2025, Calgary was sitting at a vacancy rate of just under 5% with $1,800 per month as Calgary average rent. And a 5% vacancy, anything under 5% or a 5% vacancy rate in Alberta would indicate a relatively balanced market, leaning slightly towards sellers. Now let's switch gears. Let's look at the overall landscape in Alberta right now. There are three main challenges with real estate investing in 2026. We're dealing with financial squeeze, we're dealing with regulatory waves, and we're dealing with investor plateau. Financial squeeze. Starting with the financial squeeze, we've all felt it. Interest rates have shifted the goalposts, and conventional banks are asking for more equity than ever. Traditional 20 to 25% down payments are no longer viable for scaling, creating a capital crunch. All of this is stopping growth in its tracks. Secondly, we are seeing a regulatory wave. With the 2026 energy codes and rising carbon costs, the old way of building is becoming a liability, really. Buildings that aren't energy efficient or accessible risk becoming functionally obsolete, making them harder to refinance or exit within the next 5 years. So if your asset isn't future-proofed today, it's losing value tomorrow. Finally, all of this leads to the investor plateau. You have the vision, but your capital is trapped behind high premiums and short amortizations. Without a high leverage tool, like what I'm going to be talking about today, you are hitting the wall when it comes to scaling your capital, not because you lack financial foresight and capabilities, but because you lack the right tool. Now let's go into the tool. Now we're going to talk about MLI Select by Canada Mortgage and Housing Corporation. I want you to think of it as a strategic financing for investments. Now let's dive deeper into what this program means and how you can build wealth with it. Trust me, this is real. I want you to think of it as a social contract between the federal government and real estate investors. In a nutshell, if you commit to providing units that are affordable, energy efficient, or accessible, the government rewards you with the most aggressive financing terms in Canadian history. Now, CMHC measures affordability by comparing the rent charged to the median market rent in the area. And then accessibility refers to designing buildings and units so that they are usable by people with mobility challenges, disabilities, or aging population. Energy efficiency measures how much the building reduces energy consumption compared to standard building codes. Now, the incentive. It's a way for the government, it's a way to get the government to back your loan so you can put less money down, as little as 5%, and stretch your payment out over 50 years. Somebody in the crowd was asking today, about, 20% down payment for investment and all of that. And that's why this comes in really handy, especially when we are investing, when we're not talking about primary residence. So MLI Select is designed to help multi-unit investors scale their portfolios. So we're talking about up to 95% leverage and 50-year amortization. It's the ultimate tool for turning a good project into a legacy-defining portfolio. Now, remember the capital crunch I talked about earlier? My MLI Select removes it as an obstacle to scaling, because now, instead of needing a 20% down payment for every building, you can recycle your capital much faster because you're leaving less capital trapped in the deal. Let's go into how it all comes together. Now, there are several types of property eligible for this program. There are a few properties that are eligible for this program. We have multifamily rentals. Those are any property with 5 or more units. So you can have a row of townhouses. It could be a 5-plex, or it could even be a triplex, as long as they have other doors. If they have legal suites, then that would also be eligible. That will also be an eligible property. Also, affordable housing development, single room occupancy units. So you could have a whole building that has single rooms up to 5, and then they can share the same living area, or they share the same bathroom and other amenities. That will also qualify for MLI Select. That's very common in the student region where students are. Also, office to residential conversions, and then supportive housing and retirement homes. So all of these are properties that would qualify for MLI Select. Now, let's talk about the GST rebate. You get 100% GST rebate on qualifying project, eliminating the GST 5%. So it sounds crazy to me, because at the end of the day, when you get your GST rebate, it's almost like you're dropping zero for this investment. Now, benefit up to 95% financing with a 5% down payment, 50-year amortization period, reduced insurance premiums up to 25% off, and of course, improved cash flow and return on investment. And not forgetting that you're also getting your GST rebate, especially with newer builds. So what do you need to qualify? Now, we have an MLI Select mortgage person in the house today that will be talking more about the finance side, but I'm just going to give a little overview of it. To qualify, you need an MLI Select eligible building project. So it could be existing or it could be something new. And you need 25% net worth of the value of the project. Now, that is not a problem. That's why we are here. We are here because we can help you assess all of those properties and let you know which ones are MLI eligible. Now, I'm going to transition into why we specifically focus on multifamily assets and why it makes sense in 2026. Multifamily units are a great route for the private investor because they offer advantages across 3 broad pillars: stability, efficiency, and financial control. We're moving away from the individual volatility of single family houses and moving into institutional grade asset management. Now, starting with stability. With that foundational knowledge, let me walk you through a simple example to demonstrate why multifamily outperforms. It boils down to risk. So we have binary versus fractional risk. So we have, if you had a single unit and there is a vacancy, right? That is 100% loss of income. But if you had 5 units and you had just one, and you had maybe just one vacancy, then that is just 20% vacancy. Assume here, if you have 1 vacancy in 6 units, that's 17% impact. If you have 1 vacancy in 24 units, that is 4% impact. But if it's just 1 unit, 1 vacancy in 1 unit, it's 100% loss. Now, most investors start with a single family home, and I'm sure a lot of people here probably have those because it feels familiar, right? That's what we're used to. But as I said earlier, a single family rental is a binary risk, meaning you have 1 single point of failure. As you can see on the left, you have 1 tenant paying. So this is a very good example. You have 1 tenant You have one tenant paying $2,000. If that tenant moves out, that's zero revenue. That's one tenant. But if you have a multifamily asset, say you have 4 units and you're charging $1,200 per unit, if one tenant moves out, that's just 4,800 minus 1, 2, and that's 3,600. So you still have something, still have some sort of revenue coming for you. Now, this leads me to my next pillar, system efficiency. Efficiency is where we protect our yield. In the single family world, growth usually means more chaos. You have more roofs to fix, more lawns to mow, and then more neighborhoods to visit. This growth creates friction. Now, it is far more cost effective to replace one roof that protects 4 units than it is to manage 4 separate roofs across 4 different neighborhoods. By centralizing your maintenance and oversight, you reduce your operational overhead. You're minimizing the friction of your portfolio so that as you grow, your workload doesn't grow with it. Smart investors. So you're moving out of the day-to-day landlord duties and into the role of an asset manager. And now let's talk about the last pillar, financial control. In the residential world, your house is worth what your neighbor sold for. A lot of us, if we've sold houses here, the first thing we're doing is we're doing comparables. How much did your neighbor's house sell for? You're at the mercy of the market. But in multifamily, value is a performance metric. We use the formula shown here. That's the NOI divided by the value of the house is the net operating income divided by the cap rate. So basically, this means you can increase property value by raising your rent or improving operations. So in a good market, the value increases. Example, if you increase annual NOI, that's your net operating income, by 20,000 and cap rate is 5%, you have a value increase of about 400,000. Now the skill. I want to explain how to leverage MLI Select and why multifamily units can be a more efficient and smarter asset for real estate investing. Now, every real estate investor is ultimately pursuing 3 outcomes: income today, appreciation tomorrow, and equity for long-term wealth. Now, a lot of investment properties may not give you all the 3, but you want to have at least one. You want to ensure that at least one of it is working for you. Multifamily strengthens all 3, however, because income is diversified, value is driven by performance, and operational improvement allow investors to create equity rather than simply wait for it. Multifamily strengthens the 3 wealth levers: more stable and scalable cash flow income today, better capital appreciation today, and equity building, which increases the ownership and long-term wealth. Now let's talk about the better cash flow. The most powerful lever in the MLI Select toolbox is time. While the standard investor is struggling with 25 or 30 years amortizations, we are moving to a 50-year horizon. Think of this as debt service optimization. By nearly doubling the amortization, you are significantly widening your monthly operational margin. This creates a resilient asset that cash flows even in volatile interest rate environments. Now let's talk about capital appreciation. In a single family home, value is primarily determined by comparable sales, which I've said earlier. But for a multi-family home, we're looking at the net operating income. So that's how value is determined. So you can literally manufacture your own value. And then equity building, long-term wealth. Single family equity grows through mortgage pay down, market appreciation. However, growth tends to be slower and tied mostly to market conditions. While for multifamily, equity grows through mortgage pay down, income-driven appreciation, operational improvements, strategic refinancing opportunities. When income increases, property value increases, which means equity can grow much faster. Many investors can also use refinancing strategies to extract equity and reinvest into additional properties. The result, multifamily allows investors to accelerate equity creation and portfolio growth. I hope with this viewpoint of mine, I have made it clear to you why multifamily investing is quite simply mathematically safer than the regular investing that we're all used to. It is the foundation that allows you to grow and protect your assets using the MLI Select tools we discussed. Because you aren't betting on one person's job security, you're betting on the broader Alberta economy. And as a private investor, you're able to access institutional level diversification. This diversification creates a smoother, more predictable revenue system because your turnovers are staggered, your cash flow is steady. It is no longer a roller coaster of is the house rented or not. There is a reason CMHC and major lenders prefer these assets. They see exactly what I see, lower risk. When a lender looks at a multifamily project styled to the 100-point standard, which Ahmed is going to be talking about today, they see an asset that is statistically less likely to default than a single house. That confidence is exactly what unlocks the 95% loan-to-value ratio. You are essentially leveraging the bank's own preference for stability to secure your growth. Think about it. If a tenant moves out of the house, your income goes to zero, but your mortgage stays at 100%. But for a multi-family home, you stay cash flow positive. You have the breathing room to find the right replacement and keep your capital moving without ever dipping into your own pockets to cover the mortgage. So why now? I want to leave you with a final thought. Why are we talking about multifamily today? We're currently standing in a unique window of opportunity. As Bert said, you can either decide to look at the opportunities now, really zoom into it and see what works for you, or you walk away like, I can't be bothered. First, the supply and demand imbalance in Alberta is real. Our migration is outpacing our housing supply at a rate we haven't seen in decades. As you saw in the graph it showed, it keeps going up. People keep coming in. It has never gone down. People keep coming to Alberta. So there is an immediate demand for quality, and there is a window right now to be the first to provide the units this province is looking for. Think bigger. Ultimately, this is about the economies of scale. I want you to stop thinking of yourselves as landlords and start thinking as asset managers. In a single family home, one vacancy again is 100% loss. In a multifamily asset, it's a manageable data point. At the end of the day, successful investing in Alberta isn't about how much capital you have. It's about how many times you can use it. By mastering the MLI Select tool and using design to get the most out of your net operating income, what might begin as just a single investment can turn into a comprehensive wealth building strategy. Now, this might sound like a lot. That's why we are here, to guide you through every step of the way on this unique wealth creation journey. Master the lever, optimize the assets, and keep your capital moving. Finally, if you are interested in learning more about the MLI Select and Multifamily Investments Program for wealth creation, please fill the QR code above and somebody on the team will get back to you. Actually, I am the person on the team that will get back to you. Also, don't forget to grab your sweet reward at the Adedoyin real estate stand outside. Finally, I am just going to put it out here that there are three types of people in the world. There are people that watch things happen. There are people that wonder what happened. And there are people that make things happen. So who are you going to be today? Again, I am Adedoyin and I'm here to partner with you to make informed real estate investment decisions that will define your wealth for the next 50 years. Let us build a legacy that actually outperforms. Thank you.